Well, good morning. This is Tampa Home Talk, and I'm your host, Katrina Madewell. We've got a super exciting show lined up for you today. Leo, do you even know what the topic is for today?
We're going to see how many guests we can fit in the Clown Car studio.
Yeah, something like that, exactly. But so without further ado, Mr. Leo Cannon, of course, joining us weekly. We got Adam Talley with Talley Insurance. He'll be queued up here in just a minute to do our 2-minute insurance tip of the week. And we also have Cindy MacRitchie. Welcome.
Thank you.
Keeping the balance. She happens to be my personal bookkeeper and time saver for me, big time, worth every penny. Welcome to the show, Mr. Duane Bishoff.
Thank you.
And he's going to be our CPA guest speaker for today. And of course, some of you may know and remember Mr. Darrin Mish.
Hey, it's great to be here.
The IRS Solution Attorney Show, of course.
Is this a money show?
So that's some applause for Darrin. He's liked a little better than me, I think, and that's okay.
Yeah.
We like Darrin. So, but the show today is going to be all about these tax changes, right? That you heard so much about a year ago. That's taking effect this year, which means you're actually going to start seeing some of these changes in 2018 as you file your taxes. Maybe not so much for your clients, Darrin, but for the rest of the world, maybe for you, Duane, and for Cindy. We're going to share some of those tax changes, what you can expect, and there's some big things that you need to know before the year actually ends and before you file the taxes. So without further ado, let's run on over to Mr. Adam Talley. How's it going today, Adam?
Oh, hey, I'm doing good. How are you guys today?
We're doing great. So what you got lined up today for our insurance tip of the week?
So for insurance tip of the week, today we're talking about, tax.
Katrina,
and
get
everything.
closer to your mic.
Get
Get closer to your mic. You sound like you're off mic a little.
Return or minimize what you owe. So another thing that goes along with that is obviously saving money. And when we get into the new year, we have a lot of people that finally start to look at things, and maybe they have some financial goals as their New Year's resolution. So if you are in that boat and you are going to start maybe shopping around your auto insurance to make sure you have the best rate, little tip, if you shop early, so say maybe a week or two before you actually need the policy to start, you can actually see some pretty decent discounts.
Now, why is that?
Different rating factors. I mean, all of the carriers are different when it comes to that stuff, but, I guess the people that shop early tend to be maybe a little more responsible. I don't know.
That's interesting. Never would have realized that. How about you, Leo?
Early shopping, getting your Christmas shopping out of the way in February like I do.
What about insurance?
Same thing with insurance. If you shop early, you can make a better decision. You can get additional quotes. You can find out more information about what you're about to purchase. Never make a rush business decision. I'm sure these three guests would agree with that.
Absolutely. Are you ready for the holidays there, Adam?
I'm getting there,
Yeah, dudes are never
down
ready.
to crunch time, so I got a few extra gifts to get, but
I'm not ready
close.
either.
Maybe you're not quite that responsible, Adam, in your Christmas shopping?
Maybe.
No, you
Turn his mic up.
Do as I say, not as I do on that stuff. So.
Exactly. Well, thank you so much, Adam, for joining us today. And if you want to get connected to shop that insurance early, it's never too early to start this process. You can call or text us at 813-377-2775. Just text the word insurance to 813-377-2775. 2775 will get you connected with Adam Talley Insurance, 813-377-2775. All right, so let's kick this thing off. Duane, I guess we probably should start with you, right? Being the CPA in the room. What are some of the big changes that we're looking at that we can expect, before 2018 actually ends and rolling into 2019? What's the thing that are going to surprise someone, and what's the thing that before we tell them what they need to know before they file, we'll hold that till we come back the next break. But the cool part about this, what I saw, because I filed my taxes a little bit later, right, Cindy? She had to pick up the slack for a bookkeeper that wasn't doing the job, but we actually filed a mock tax return, and my refund would have been bigger, based on last year's tax return. So I thought it was pretty cool. And you ran some mock tax returns as well, right?
Yes, I did. I ran three different.
He's off mic.
And
there we go.
So we ran a couple different situations. The first one, we had married couple, 2 children. Taxpayer has a small business that has a $90,000 profit. The spouse works with the $40,000 W-2.
Okay, so we got one wage earner, one self-employed person.
Correct.
Okay.
I want this scenario.
They have real estate taxes at $3,000, mortgage interest $1,100, and donations of $1,500. So the difference, if we ran that same scenario in 17 and 18, the tax decreased in 18 by almost $7,000.
So their refund essentially is going to be $7,000 larger?
Correct. If they had a refund, yes.
Wow. So, all right. So can we talk about just a couple of these things? Because I think a lot of people were upset about the tax changes. And the idea, of course, was to simplify it. I'm sure you'll have some comments on that soon, Darrin. But first of all, is the mortgage insurance deduction going away?
No.
The interest, sorry.
Yeah,
interest.
the mortgage interest is not going away. The main thing that happened there is new mortgages. There's a limit to the amount of mortgage interest you can deduct. So it's up to $750,000 of mortgage. It used to be $1 million.
So they capped it where there was no, or it was $1 million before?
It was $1 million before, right.
And so who might this not work out so nice for?
Yeah, so
in your scenario too, let's talk about the income as well, the total income.
Yeah, so I'm thinking it's not going to work out for the main people. It may not work out. So anybody who had employee business expenses, so they were a lot of salespeople are W-2 employees, and they incur all their own expenses. Well, they lost all those deductions. I have a client who had about $40,000 of employee business expenses, and she's just going to get killed. She's going to get killed by this.
So the self-employed people, somebody like me, like Leo, like Darrin, right, like most of us in this room, is it the tax change is actually better for self-employed people?
Yeah, for the most part, right. Yeah, the biggest thing we're missing if you're self-employed is entertainment is no longer deductible. So
for example, if I were to take my clients to a Bucks game,
right,
and I bought the tickets, I can no longer deduct that.
Correct.
That's correct.
Right.
And so what else would you see oftentimes in this entertainment category?
You see anything from going to golf outings, going to the plays.
What about taking them to dinner?
The dinner is still deductible. So dinner is still half deductible like it's been before.
So you can deduct the dinner but not the dancing, I guess, right?
Right.
Something like that.
Right.
So what else? What other changes are in there outside of like entertainment? What else can't you deduct? And then like in a nutshell, what did you think this tax code did exactly? Did it just change?
The big thing it did is there's the new section 199A. So two things that happen. If you're a C corporation, they reduced the tax to a flat rate of 21%, which is huge. Literally, my clients, I probably have 5 C corporations, and I probably have 300 S corporations. So hardly anybody is doing that.
So did that go up or down?
It goes down.
So it went down for C corps. Okay.
Right. And then in S corporations, so pass-through entities, which is S corporation, partnerships, or if you're a sole proprietor, there's a 20%, this new 20% deduction off your net income.
And what was it before? Or just it wasn't there?
It wasn't there.
Okay.
Right. There was something there that was kind of there for some people. It was domestic productions deduction was 9%. So you had to build things. You had to build houses, build widgets or something like that in order to qualify for it.
So are businesses still going to be able to deduct their everyday expenses?
Yes.
So that part's not going away?
Nope.
So the 199A deduction is just like a windfall. Right. And the way I see the new tax bill is the little guy, the average home, mom and pop wage earner, they're going to get a tax break. The ultra wealthy, the C corporations, they're getting a huge tax break. And then the people in the middle, I would say the people that are actually going to get hurt the worst by the tax bill, in my opinion, are the people that run the specified service businesses that have a cap on how much they can earn before they can take the Section 199A 20% deduction.
Give me an example of a specified service business.
The reason I brought this up might be because I'm an attorney, and attorneys get hit by this. Attorneys, doctors, I believe accountants, consultants,
financial planners.
So how so? What does it look like for you last year compared to this year when you file?
I'll still be fine. I'll still be fine because I've got enough planning in place. But, it's after $315,000 for a married filing jointly couple, then the 20% starts to phase out. And I think it's $415. Yeah, it phases out completely at $415. I don't have a hard time living on $3.15, so I'm going to be okay. But there are people,
20
especially
seconds.
physicians, are going to get hurt really badly by this.
Oof. Like the healthcare bill changes weren't enough. Anyway, you're listening to Tampa Home Talk. When we come back right after the break, we're going to tell you something pressing and urgent that you need to know before 2018 closes and you file your tax return next year. We'll be back in a minute.
Well, good morning. We're sitting here at Tampa Home Talk, and if you want to reach us on our off-air number, I'm going to just read it off the monitor, 813-377-2775. That number is
813-377-2775. Again, you can call or text that number.
You can text?
You can text 813-377-2775.
That's awesome.
You need some real estate help.
Is that number tax deductible?
I don't know. That's a better question for the experts in the show today. Still tax deductible, right?
Absolutely.
ABS line, we can track some stuff. So, Darrin, it's interesting. You mentioned attorneys are going to get really hurt by this one. Or doctors, maybe attorneys.
I don't know if really hurt is the right, I don't know if I phrased that exactly right. I think they're going to be somewhat discriminated against because the people at the lower end of the scale are getting their tax break. The people at the way higher end of the scale are getting their tax break. But nobody, let's face it, nobody feels sorry for doctors and lawyers. It's just a fact of life. And so
they might feel sorry for you guys if they see your student loan debt.
Yeah, they get crunched in the middle.
So, so it's really the higher wage earners that are specialized practices. Is that what you're saying?
They have to be in specialized
services.
Right.
Yeah.
So does real estate fit into that?
I don't think it does.
I don't believe it does.
Engineering?
Yeah, engineering does not. It's specifically carved out.
All
Awesome.
right, so who else?
They have a great lobby in Congress, apparently.
So yeah, basically healthcare, doctors, insurance, real estate. I mean, not real estate. Financial advisors, financial planners.
So it's interesting that insurance is actually going to get the brunt of this. And I think I read something, and I want you to clarify this, because this has always bothered me. At the end of the year, a lot of companies will take those profits, right, as a personal distribution because they don't want to get sort of taxed on it twice. Is that fair to say? Did that change?
If it's a C corporation, that's correct. If
Okay.
it's an S, it's not really correct.
Okay. So, but there was never really any incentivation for businesses to hold profits, right, or retained earnings going into next year.
Right.
Is there any changes for that going into 2019?
Well, just the lower tax rate now at the C corporate level makes it more plausible for them to hold on to those earnings and grow.
Okay. So, what else is a major change or shift that might really surprise someone that we should know about? Because this was a pretty big tax code change, right? Like, how many pages was this thing, Darrin? Do you know? Like
There's a book right
bazillion.
there.
That's the book on the tax code?
I thought that was a phone book.
Okay, grab that book, Darrin. I'm
I
going to show
really
it.
thought that was a phone book. I thought we were going to have a bodybuilder rip it in half.
Like the phone
Just-
book is not even this big anymore. So this is oh my gosh. Are you
explanation.
looking at this, Pat George, on our live stream on
And what's the
Facebook?
font size in there? It's about 4
This
point.
is the tax code change. It's not, oh my gosh, it is small. Like if you're over 40, you're probably not going to be able to read this without your bifocals. I'm just saying, oh wow.
Thank
So
God
you
for
have
Who would
read
want to
this
read
whole book.
that?
Yeah.
Who would want to read that?
Well, Pat.
Do they give you
sometimes-
like a short and skinny CPA version class for that book, or you guys actually have to read it?
No, I mean you thumb through. I thumbed through. I didn't read everything. I thumbed through things I thought were affecting my clients.
So kind of along that line, I went to a seminar, an 8-hour seminar on the new tax bill early in the year, and I left more confused than when I arrived.
Oh, no.
This new tax bill is quite confusing in my mind, but I think as more and more experts pour over it, distill it down, and we understand more what's in it, then it'll become more clear. But when you have, for the listeners that, on the radio, this book that we're looking at is, I don't know, about 300 pages of about 4 point.
There's 3,000
Over.
pages.
Well, 3,000 sections.
Here's the page number.
Oh, 600.
Okay, so it's
I like
600.
my
But even
better.
the book is confusing.
The book's confusing. Why are there two sets of numbers where you put page numbers?
Look at it. It's almost 1,000 pages, though. Really.
So 1,000 pages at 4-point type for the new law, the new simplified law alone.
Now, didn't you say before the show that there's actually some law that these new tax changes are bumping into? Didn't you say that?
I'm not sure what you're referring to.
Like, I thought
but
you said there was some conflicts with the new tax code changes compared to some things already written in the law. Is there anything that contradicts them or they have to fix?
Not that I can think of right now, but I don't expect that those won't show up.
Yeah.
Because what happened is this law sort of got passed in the dead of the night, sort of like Obamacare got passed, right?
That was insane. It's still insane.
We have to rush to pass this, because if we don't rush to pass it, we're not going to get anything passed, so let's just pass it. I mean, that's what happens. And the lawmakers don't actually write these laws. It's their staffs that write the laws. And the staffs are subject to lobbying pressure, and things like that.
Right. So, which is like all the behind the scenes type of stuff. How do you think this is going to impact your business, Darrin? Because, for the person that hasn't listened for a long, long time, maybe you haven't ever heard, but Darrin and I, north of 2 years, did a show called the IRS Solution Attorney Show. And did I mess that up? I think I
did it right.
The IRS Solution Attorney Show. And we talked about some of these people that have huge tax problems, and some of the legal jargon and the IRS jargon that most people don't know, and how to avoid some of these problems and what your outcomes were.
Right. So my practice, obviously focuses on resolving tax problems that people have, and typically my clients owe 6 figures and above, but not always. And so how I expect the new law to impact that, it hasn't impacted us much yet, because nobody's filed a tax return under the 2018 code, right? But I can foresee, if I'm confused, if Duane is 1% confused, then there's going to be problems that arise from the new tax law. It's absolutely a positive certainty, and that's when I will actually be able to dig in and figure out how to resolve those issues.
I can see where you're coming from there, because usually there's a foreword at the start of the book, like a dedication. I dedicate this book to my wife or my children or something.
Not in this book.
This book is just 5 paragraphs of disclaimers.
Checkpoint.
It's just disclaimers, and it's just like, this book is meant not to be comprehended, and we're not responsible for the content in it. I mean,
is that what it says?
Pretty much.
Oh my gosh.
I don't make this stuff up. You know me.
And for me, being a bookkeeper, I have to get ahead of the game here and make sure everybody's clients' books are up to date and all the chart of accounts are right. For example, the meals and entertainment, that is now separate. Because you can't write off the meals anymore, I had to separate the meals and entertainment. And then, of course, the meals for travel are now considered meals now. You can't even write them off as travel.
Oh, wow. So how do you fix that as a bookkeeper if it's been always that way, and now you've got this return with all these major tax changes?
Well, I have to go back in the entire year and reclassify all those transactions.
So if you're traveling and you're having meals out, that's no longer a tax deduction when you're traveling?
It's a tax deduction, but only at the 50%.
That's
it's not
so
under
unfair.
the travel anymore.
So that's a great example. If the taxpayer is not fortunate enough to have Cindy go in and reclassify those things, without a doubt, there will be people who don't reclassify those things. That will trigger an audit.
Do you think that they're going to be looking for that kind of stuff, Darrin?
The computer is going to be looking for that kind of thing, and it will definitely trigger audits. Especially, it's really unfair. What I see in terms of audit rate is I see the very little guy, the person who puts unreimbursed employee business expenses, which I guess don't exist anymore,
right?
But would claim $1,000 of unreimbursed employee business expenses gets audited, and then the people who claim $200,000 in contract labor and never issue a 1099.
So if there's a W-2, there's absolutely no way for them to write that off anymore, those expenses.
Correct.
Except for teachers.
Well, teachers still have to get their $250 classroom deduction. But yeah, if you're incurring your own mileage, you're incurring your own meals, you're buying donuts for your clients, you're buying samples or whatever, you're not getting a deduction for that anymore if you're a W-2 employee.
Wow.
I'm so
do you
glad
think,
I'm an S-Corp.
So, Darrin, this might be a question for you. Do you think more people, especially like that, where they were W-2, but they had like all these reimbursed business expenses, now that they can't write them off because they're not reimbursed. Do you think we'll see any switches there from W-2 wage earner to 1099?
It's possible, but then you run into problems with employment law too. I've been trying to tell my clients to get in front of this when we were doing their tax return last year. Hey, look, you need to go to your employer and see if you can get this reimbursed. Even if you get it reimbursed and reduce your salary, you're still coming out ahead because your same amount of money net, you're going to have less taxes. So,
Cindy, what else is another example? Because that was a fine example. Meals when you're traveling is now only meals, not meals and entertainment.
That's correct. That was the big one that I noticed.
So I have a curious question, totally off topic, but I mean, I have an LLC for Tampa Home Talk, right? So I'll use
Correct.
myself as an example because I can, right? But we used to actually buy tickets. For example, to the Bucks games, we would give them out on air. We bought concert tickets, we would give them out on air. Is that still a deduction?
That is
Do you know?
not. No,
No
No,
longer
because it's
deduction.
entertainment.
Right.
it's entertainment.
Although maybe we could shoehorn it in.
So
as a
there's
gift.
two. There's
Even for broadcasting?
There's a couple different. So you have to dig into whether that could be advertising promotion because you're
Well,
not.
that's what I'm thinking. It's
Because
more
you're not
promotions.
going to you're not entertaining them. You're not going there with
Right.
them. So that could be
So if I'm not with them, it would be more promotional.
possibly.
versus that-
We'd have to look into that. Yeah.
Yeah, so that's-
the
I
way
know
that
it's
people
a-
are looking to.
That's
do
when
So-
you need professionals to be persuasive.
What are you guys going to do when you get hammered with all these questions next year for very specific examples like that?
Yeah, you just have to come in. You have to research it, pick a line that you're going to take, and just go with it.
So are you guys taking your vacation right now? Because I don't think you're going to sleep.
Only the third week of January.
All right, so this is Tampa
30
Home Talk.
seconds.
We're going to talk a little bit more when we come back about the startup of the tax season, when that actually files, how early you can file, and we'll get into some other things, including like standard deductions. We're going to give you some ideas of what that's going to look like in a couple
15.
different price brackets. Stick around. Tampa Home Talk will be back in just a minute. Our off-air number is 813-377-2775. We'll be back in just a moment. Welcome back. This is Tampa Home Talk. I'm your host, Katrina Madewell, hanging out with Leo Cannon, Cindy MacRitchie, Duane Bishoff, and Darrin Mish. We're talking all about the tax changes of 2018. The year is not yet over, and there's a reason why we're doing this show right now in December before the end of the year. And as I'm talking to you guys, I realize we probably could have done this show even a little bit earlier.
Yep.
Don't you agree?
Yes.
All right. So one of the things before you move on, Duane, or before we move on, I should say, with regards to the S corporation, right?
Yes.
That is not taking a salary, right?
Correct. So there are many people out there who have an S corporation and don't take a salary. They take all their profits as distributions, and it's really what they shouldn't do. They're on the IRS's radar. But specifically for this year, if you don't take a salary, you are not going to get that 20%, Section 199A deduction.
Reasonable salary,
you need to take
right?
a reasonable compensation.
Which,
there are
Darrin,
ways
as an
to-
attorney, you love that word.
Yeah, yeah.
I can see lots of people running into that issue because the people that I tend to represent don't take reasonable salaries,
So
and that's
how
one of the things
do
we
you
have to try to
know
get them
what's
to fix.
reasonable? Like, where can you look that up?
There's actually people who have businesses that compute that for you. We use a standard.
All right, what kind of business is that? We're going to have to bring them on Tampa Home Talk to talk about that so you guys don't run into
There's
problems.
a couple different consultants I've met through different, conferences that I've gone to.
Okay, so we're going to get the connection from Duane, and we'll have a guest on, unless you got some connections, probably Darrin too, that talk about reasonable. And you said you spent a whole year in law school talking about
Yeah, we
this.
did. In torts class, we spent about a year arguing about what the word reasonable means, and we don't have any better idea when we're done than when we started. But when I was a younger attorney, I used to base my reasonable salary on what I earned at the government when I worked as a public defender, and I did that for probably a little too long, until one day I kind of woke up and realized that I had been practicing for 20 years and my reasonable salary was no longer reasonable.
Well, here's the thing. For you, it's probably a little bit easier to see that. For somebody like Duane, it's probably a little bit easier to see that. For somebody that's the lay person, outside of you three, maybe somebody like myself or Leo or somebody else listening, how would we know what a reasonable salary is? So, I don't know.
It starts at minimum wage.
Oh, well, that's a good
It starts
indicator.
there, but some small businesses don't make a whole lot of money, and so that's what people ask me: do I have to take a salary? I said, well, you need a profit before you need to take a salary. They
course,
can't make you take a
yes.
salary to make a bigger loss. So we look at each case specific by each case by itself, and then we try to help determine something. So they're paying in. I think like Darrin said earlier, if you're paying yourself something, you're probably off the IRS's radar, and because they're looking at the people who aren't paying anything. So
I'm going to go out on a limb and say, if you have no idea, if you're listening to this and you have no idea what a reasonable salary is, but you're making a profit, it's probably in the range of 20 to 40%. I mean, again, I'm out on a limb
Of
here.
your gross revenue?
Of your gross profit.
Gross profit. Okay.
Yeah, see, I use a higher number. I use like 50 to 60.
So I'm used to defending disasters,
Got
right?
it.
I think
Yeah,
I
yeah.
could probably get by with 20 in some scenarios, 40 in others. 60 would be incredibly great and easy to defend.
But if you're under 20% of gross profit or your net profit, gross profit? Gross profit.
Right, but gross
Revenue.
profit, not gross
Okay.
revenue. So, 20% if you're making $200,000 a year is 40,000, right? So if it's 2 million, then you're above the FICA maximum anyway. The FICA maximum is the amount beyond which they stop withholding Social Security, and so it's sort of irrelevant. If you're at the FICA maximum, which I think is about 115 to 125, somewhere in there.
Somewhere in there, yeah.
If you're at that rate and you're paying yourself that reasonable salary and everything else is distributions, I think you're rock solid fine. That's reasonable.
What if you have this yin and yang kind of business, right? Like sometimes real estate can be this yin and yang business where it's way up, it's way down, and certainly somebody like me wouldn't want to come see Darrin because I'm in a tax roll problem. What do you do with that?
Well, as a bookkeeper, I'm looking at my clients' books all the time, so I see where their profit is and I see where their cash flow is. So I can tell them, you need to take a paycheck this month. You need to start taking a paycheck. I have clients that I tell them that, and then they don't take their paycheck at all. And then they end up in the problem that Duane was discussing.
So one of the things I want to remind you, and when Darrin and I were on the air all the time, we used to talk about this all the time. You can make tax payments to the IRS daily if you want to. So why not pay it weekly or when you get paid? That's the best way to stay out of tax problems, wouldn't you say?
Absolutely. The whole quarterly system where you're supposed to make your estimated tax payments quarterly, in my mind, is ridiculous.
I would say anytime you take money.
Because nobody budgets on a quarterly basis, or very, very few people do.
And real estate agents are the worst, right? Like, thank goodness I've never had to see you for a tax problem. But real estate agents are the worst about paying their taxes on time. When they get a commission check, they should pay taxes on it, but I think really they should draw a salary and put everything else back into the business.
I had a real estate agent in my office this week that it was the same thing. I had to explain, why don't we take, a percentage out of each commission check and go ahead and remit it to the IRS? That way you're going to be ahead of the ballgame. But real estate agents are a really good example for reasonable salary in my mind, because I think we could defend what the lowest paid real estate agent in the office
Have
makes.
you seen those national averages,
Isn't that
Darrin?
lower
Yeah.
than
Because
minimum
literally
wage?
the national average is 5 to 7 deals a year. And if you do
I
25,
think we could defend that.
you do 25 plus, you're considered a mega agent like me. We do way north of 25 deals in a year.
I think we could defend that as a reasonable salary. So I'm taking a little bit of the contrarian viewpoint here, and I don't want people out there to listen to this and think they should be overly aggressive. But reasonable is one of those words that's very difficult to define.
Again, it's just people with S corps.
Right,
Yes.
correct.
Yeah.
If you're a sole proprietor, you don't have a problem with
Right.
it.
So let's get into some of these standard deductions because it will affect and change things a little bit different, right? If you're married, filing jointly, the standard deduction would be like 24,000 up from like 13 grand, right? So that's
Correct.
pretty significant.
Right,
It
but
is.
you lost one of the things is you lost your exemptions. So the exemptions that you had for your kids and yourself, you lost those.
I guess that's good for me now that I got one that just turned 18 and, a couple more on their way out.
But they increased the child tax
credit.
right, from 1,000 to 2,000, and then if they're too old to qualify for that, you get a $500 credit. So it's still that kind of offsets that exemption.
So mortgage interest is still deductible, which we got that question a lot. And I was like, I'm not answering it yet. I'm not sure because I wanted to be sure
Right.
before we told anybody that.
But can I ask a question about that? So the mortgage interest is deductible, but all your deductions have to be over that 22,000.
24,000, correct.
So it kind of makes things easier for me because if I have less than 24,000 in itemized deductions, I just go with the standard.
Absolutely.
And I think a lot of people are just going to go with the standard deductions now because they're not going to be able to do the itemized. They're not going to have enough itemized deductions.
Well, think about it. It's so much easier than trying to keep track of this and keep track of that. Like, it's going to be a lot less tax audits, don't you think?
And I would say this is the simplification part of this tax
Right.
bill is right here, that what we're talking about,
Correct.
the standard deduction going up to 24,000. Far fewer people will itemize.
Right.
So,
So if your deductions are over 24, you still can itemize, is what you're
Absolutely,
saying?
absolutely.
But I would say your risk of an audit's probably going to be higher. Would you agree with that, or we don't know yet?
I would disagree.
I agree.
Most likely.
You think
but
so?
the audit rate on the people who claim the standard deduction is going to plummet because there's no church donations to and goodwill donations
So
to
those
audit
are going
anymore.
away.
Well,
Yeah, pretty much.
those deductions are not going away. It's just going away for, I don't know what the percentage of the population is. Probably 60% of the population now is just going to take the standard deduction, not worry about itemizing, and so you don't have to gather all those church receipts and the goodwill receipts and the those things. I don't know what the standard average amount of home interest deduction in Florida is, but it's probably $2,000 to $5,000.
Well, I know for me, I'm happy I got locked in on a ridiculously low rate when rates were, the feds were buying money at 0%. So I got locked in under 3%, which is like, I'll never see that rate again in my lifetime. And I did a 15-year mortgage, and I'm accelerating that thing. So for me, the standard deduction is amazing. And, it's where I'm going to see less and less and less.
Right.
So what about IRAs? Is there any is anything changing in terms to IRAs or like Roth contributions or anything like that? Because I saw there's some changes on those. So I think the notes that I have, and you tell me if this is accurate, the individuals who are single filing head of household, the income phase out has been raised to $120,000 to $135,000. For married couples filing jointly, the range climbs from $189 to $199.
Right.
And so there's some extra benefits in there, and so they changed the tax bracket, right? So the lower taxable income folks actually pay less in taxes.
Correct.
Yeah.
And then, as we've talked numerous times, Darrin, I know you and I have talked about this a million times, that what people would consider the rich are going to pay more than their fair share of taxes. So in that bracket, would you say they're actually going to pay less?
In the rich bracket?
Yeah,
so to
like
speak?
so.
Yeah.
So
Yes,
for
absolutely.
example, this thing caps out at $600,000 and up, and then it says that their tax rate is going to go to 37%.
Well, if you think about who we characterize as the rich, right? They're typically business owners. Right. I mean, you have some doctors in there, and you have some athletes in there, and you have some really high paid employee type folks that are super specialized in that regard. But primarily the people that we consider to be rich in our society are all business owners. And so the changes to the tax code with regard to the C Corp, being capped at 21%, and the S Corps with the rates actually going down, plus the Section 199A 20% deduction, the rich are actually going to be helped as well. Like I was saying earlier in the show, it's those highly paid highly compensated individuals in the specialized service industries that are going to kind of get crunched a little bit. But again, they're going to benefit from the standard deduction going up, from the rates going down.
Top rates going
they just
down,
won't
right.
benefit as much as the people on the opposite ends of the spectrum. The
Yeah.
poor, the poor to lower class folks are going to get a nice bump. The very wealthy are going to get a nice bump, and those people in what we would probably consider the upper middle class are going to get pinched a little bit.
So let me ask this to see if it's really as simple as I'm thinking. But for example, we'll use $100,000, right? That puts you in a 22% tax rate from $77,400 to $165,000. So if you're at $100,000 even, are you getting just a straight $22,000 deduction? Is that how that's working?
Yeah.
Is it that simple?
So the $100,000 to $24,000 comes off the $100,000. So now you're at 76, and then you figure your rate in the 76 bracket, and
There you
that's
go.
where you go.
So it's a deduction before you get taxed, or
Yes,
Okay.
before, to come up with taxable income.
Okay.
There's some other folks that we haven't talked about that absolutely are going to get pinched, and those are the people who are in other states and pay state and local taxes. So the people in California that pay more than $10,000
Yeah.
a year in property taxes are just irate about this. I don't think that was an accident that the
Yeah.
Republicans did that, by the way. And also, you're not going to be able to deduct your state income taxes
Which,
anymore
by
either.
the way, Florida has none.
Correct.
And I got to tell you, I know a ton of people in California, as do you, because you're from there, Darrin. And I'm seeing more and more people say that they are going to other parts of the country besides California because they're not business friendly. They're politicians. I probably shouldn't say that on the air, you know what. But they just, ultimately, it's just not a good state to live in. Like their water is
15.
ridiculously off the chain for no use. So, all right, when we come back in just a minute, we're going to talk about who some more of these folks are that are going to be impacted by the 2018 tax change. We'll be back in just a minute. Talk, thanks for joining us today. Our off-air number, in case you want to connect with myself, Leo, or any of our guests at any time,
You're
is
off mic.
813-377-2775. Again, 813-377-2775. You can call or text us at that number, 813-377-2775. And we were rolling into a point before the break, and I already forgot what we were going to talk about.
I have something to talk about. This is awesome. Fresh new paper in my hand.
All right, hold that. We're coming at the end of the show to talk about that. Hold on.
I love talking. There's numbers. There's nothing but numbers here, but I'll be patient.
Couple minutes, Leo.
Okay.
So, I know we were just talking about what happens with withholdings, right?
Correct.
So the number of people, like, walk me through this. And sometimes I know there's families that, like, I don't even know what you're supposed to withhold, how many people, like, how that should work.
So I guess my takeaway I was trying to come up with was you're supposed to see this big. Everybody's supposed to see a tax savings. Well, if you don't see it in your refund, it's because they changed the withholding tables back in February. So your paychecks went up a little bit every week. Well, that was part of this tax savings that you're going to get right now. So when you do your return, if your refund isn't as big as you thought it was going to be because you saw these tax savings, you've got to look at your total tax compared to the prior year total tax and see. When you look at your withholding, it's probably going to be less than it was the prior year. You've already gotten some of your refund. So and some people could owe because the withholding went up. Particularly,
if you got a lot of entertainment or like those unreimbursed expenses in your W-2, you're probably going to see this.
The other issue is people that hold part-time jobs. A lot of millennials have different part-time jobs, and the tax tables the withholding table is not set up for people having multiple jobs.
So these little Uber drivers, right? Like, that's a good example, isn't it?
Well, they're self-employed, so they're a little bit different.
Okay.
But anybody who may do a little waitressing job over here, a little office, answering a phone at this office, and something over, tending bar, whatever, somewhere, and they have 3 different paychecks, they're going to, or work just part-time the same thing.
It could affect them.
Yeah, because they're withholding. It thinks all they make is what they make in the one job. When you put all those 3 wages together, you make a lot more, so the withholding would have been a lot higher. So I see that a lot in my practice with people who have multiple jobs.
And
real
quick, mileage is still deductible, right?
Correct.
Like mileage, thank goodness, because
Yeah.
that's a big one for me. Like,
well, it is if you're self-employed. If you're an employee, it's not.
Right.
It's a employee business
Yeah.
expense.
And
So think of the pizza delivery drivers, right? Who are going to really have a hard time because they're not going to be able to write off that mileage.
Right.
That's correct.
now, Darrin, you said alimony is no longer tax deductible too?
No, alimony paid is no longer tax deductible, and it's no longer taxable to the recipient of the alimony. And so I can
Where
see
did that come from?
I think that's on new divorces that happened in.
Does it depend on when they
18,
occurred?
Yeah.
Yeah, it depends on when it occurred, but I can see that becoming a problem because sometimes I see people come in and they're paying crippling alimony, and it's no longer deductible. It's taxable. You have to pay the tax. Then you get to pay the alimony.
So if you're in a divorce and this is a topic for conversation on how you're going to divide assets, you might want to pay attention to this tax code change
Correct.
before it actually affects you.
Yep.
Yes.
All right, what other big surprises can people see, or what should they expect or watch out for?
I mean, the other one that's kind of a bonus, again, it's to small businesses or big businesses, is that when you buy fixed assets or equipment, you can write them off right now. There's no limitations. If you buy it, it's an expense. It's huge. We've had a big business that, they were expanding a mill and, $5 million expansion. It would have had to been taken over 7 years before. Now it's just 100% deductible.
Don't forget small self-employed people, those S corporation folks, make sure you're taking a salary.
Yep.
If you're not, make sure you do it before the end of the year. Otherwise, you're not going to get that deduction, which
Absolutely.
is pretty big. It's going to affect you. Okay, so our off-air number, 813-377-2775. If you want to connect with us, you got a suggestion for a show, you want to talk to one of our guests, we'll be happy to connect you. 813-377-2775. And so what properties do we have lined up for today, Leo?
Ooh, I've got a couple of nice ones. Let's start with 12325 Prairie Valley Lane. It is 3,000 square feet in Riverview, 6 bedrooms, 3 bathrooms, because if you make the money that Darrin's talking about, you need this house. And you can get it at the tax rate of $315,000, that magic number. This house is at that number. If you have a little more expensive taste, we do have 8801 Rustic Trail Court. This is just under 3,000 square feet, and for $350,000. It's in Tampa. It is 5 bedrooms, 2 bathrooms. And my exciting one of the day is if you'd like to have your own acre of land to put whatever size house you want, you can get this at a steal at $45,000. It is 6848 Quail Hollow Boulevard.
Yeah, it's just under an acre, so it's not showing up on the radar for a lot of people.
We all round here in this room, right? Bookkeepers, accountants, legal. We round up.
And we're not allowed. We get fined in the MLS for doing that. So we can't.
0.99999. Eventually, there's so many nines, you just round up to 1.
And by the way, a brand new listing. I don't know why it's showing 8 days on the market because it was off the market while the tenant was vacating, but it actually just hit the market last
Oyster
night.
Shell Trail.
No, 4407
Oh.
Venice Drive. That one's a cute little 3-bedroom, 2-bath house. It's $160. It's in move-in ready condition. Super, super cute. Low HOAs. Really great neighborhood. And we are doing an open house on that one, 4407 Venice Drive in Lake Pageant East this Saturday from 12
Awesome.
to 4.
Love open houses. I love we broadcasted from an open house one time.
Yes, we did.
That
The
was
house
a lot
is
of fun.
sold.
It's 3392 Carrera Court.
Oh, you remember the address. Good for you.
The numbers.
And we've got a great one coming up on a ski-sized lake. So if you're interested in something like that and you got the time to wait it out because it's going to be a short sale, it's on 0.63 of an acre, over 2,000 square foot, 3.2. It's going to be priced just at $350 on a ski-sized lake.
Is the ski,
Snow ski?
Is he a snow ski? But is the
Jet
ski
ski.
itself, is the jet skis tax deductible if I'm a business?
No. Unless
Okay,
you're running
so
a jet ski operation.
What if you're a real estate agent and you're showing waterfront property by boat? That might be, right?
We've actually done that. Actually, I have a realtor that does that over in Tarpon Springs.
No, I mean, it's a very viable question. I know for me, when I've had folks in, especially that are moving from out of state, there's all these different waters. You don't know what the depth is of the home, especially if it's coming into a canal and if it can get through there and if there's bridges. You can look on the map, but those are definitely questions people have. And so somebody like me would be either renting a boat or buying a boat. And it's interesting, Cindy, I think I shared this story with you, but my prior CPA gave me a hard time for that and said, "You're pushing the envelope." And I said, "No, I'm not." Because I asked, if I bought a boat and it was part of my real estate practice and I legitimately used it for that, is it a write-off?
Right.
And she's like, I forget what she said, but something like, "No, and you're so extreme," something like that.
To be honest with you, the answer is you'd have to weigh the personal use and the business use.
Yeah, the
the business use would be deductible.
That'd be a
No
fun one
farm
for you to
story
bet.
from Darrin?
Yeah,
No
that's,
farm
I could
story?
just see
Come
getting
on.
that one.
All right, my off-air number is 813-377-2775. We'll be happy to connect you with myself if you need some real estate help. Leo, if you actually get affected by some of this hail that's moving around,
Oh,
he can
love
help
hail.
you out. If your books are a total mess, you want to reach out to Cindy MacRitchie. Of course, Duane can help you on the taxes. And if you already got the tax issue, Darrin's your man. All right, this is Tampa Home Talk. I've had a great time with you guys today. How are we doing on time, Pat? We're doing good?
Got about 20 seconds. Got
All
time
right.
for a farm story from Darrin?
I wish.
So here's the big update on the farm. We're getting cattle by the end of the year. And I'm not going just normal brown or black cow. We're going Longhorns and Watusi, baby.
All right. Well, remember, love where you live, or I'm going to fix it. Welcome home.